Nvidia is still a monster cash machine, but at $225.16. The setup is not a clean buy, and it is definitely not a short. The call here is hold. Keep the core position. Do not chase. Do not bet against it. And only put new money to work lower with limit orders. That is the whole thesis. Now let me show you why. This report is anchored to August 15th, 2026. Using the latest close from August 14th, $225.16. Let's start with the chart, because the trend is undeniably strong, but the short-term risk-reward is getting awkward. Price is sitting above the 10-day exponential moving average at $218.59. Above the 50-day simple moving average at $206.52. And above the 200-day simple moving average at $194.75. That is the textbook bullish stack, 10 over 50 over 200, with price on top. Momentum agrees. MACD is 5.28, above the signal line at 3.23. And the histogram is 2.05. It is above zero and still expanding, so momentum is not dead yet. RSI is 63.04, bullish but not overbought, with room before 70. Bollinger Bands frame the battlefield. The middle band is $210.39. The upper band is $232.29. The lower band is $188.50. Price is living in the strong zone between the middle and upper band, about 3.2% under the ceiling. A TR, the average true range, is 6.93, down clearly from the June peak. Translation: volatility has cooled. This looks more like a steady grind higher, not a chaotic melt-up. From the July 29th low at $190.01, Nvidia bounced more than 18.5% in about 2 weeks. That is a V-shaped recovery. Supports, from nearest to deepest, are 218.59, then 210.39, then 206.52, then 194.75. Resistance is 227.49, the intraday high, then 232.29. Then the 235 to 240 zone, where old trading congestion and psychological resistance stack up. But here's the catch. The trend and momentum are aligned, yet August 14th volume was only about 75.5 million shares, below the recent average. So you have a low volume rally after a very fast run. That combination often begs for either a pullback or sideways digestion. Now the fundamentals. This is still the core moat, growth plus cash flow. For the latest quarter ended April 30th, 2026, revenue was $81.615 billion, up about 85% year over year, with multiple quarters of nearly 20% sequential growth. Gross margin was 74.9%. Operating margin was 65.6%. Net income was $58.321 billion. But that included $15.936 billion of investment securities gains. Strip that out, and operating net margin was still about 51.9%. Diluted EPS was $2.39, accelerating quarter by quarter. The balance sheet is close to ridiculous. Total assets are $259.474 billion. Cash-like assets, meaning cash plus short-term investments plus long-term investments, are above $140 billion. Total debt is only $12.348 billion. The current ratio is 3.441. In plain English, they have mountains of liquidity and very little leverage. Cash generation is the headline. 1/4 of operating cash flow was $50.344 billion. Free cash flow was about $48.587 billion. Buybacks were $19.312 billion in the quarter, annualizing near $80 billion. That is a company returning cash at industrial scale. Valuation is the surprise. Trailing PE is 34.48. Forward PE is about 17.57. PEG is around 0.6. For a company still growing this fast, the forward valuation is not crazy. But there are yellow lights. Inventory jumped from about $11.3 billion to $25.797 billion, up 128%. Much faster than revenue growth of 85%. That can mean smart stocking for a new product cycle, or it can mean over-ordering. Accounts receivable also rose sharply, roughly matching revenue, but cash collection quality still needs monitoring. And about 27% of the latest net income came from one-time investment gains. So earnings quality is more exposed to capital market swings. Fundamental conclusion: AI data center demand, growth, and cash flow remain the strongest support. The balance sheet is almost bulletproof. Forward valuation is attractive. But inventory growth and non-recurring gains are the two things to watch like a hawk. Now sentiment and news, because this is where the split gets loud. Institutions sound cautious. Nvidia's financing guarantee tied to an open AI data center in Ohio was cut from roughly $250 billion being discussed in the market to under $120 billion. And it covers only phase 1. The market read that as concern over risk exposure, with Nvidia actively lowering leverage. There are also physical bottlenecks: chips, skilled labor, and power. Those can slow data center build-outs, and you are hearing a new narrative. The next AI winners may look nothing like Nvidia or Micron. That is valuation fatigue at the leaders. On the positive or neutral side, Nvidia disclosed about $21 billion of SpaceX exposure through XAI-related investment, making it the second largest holding and adding strategic synergy imagination. Amkor Advanced Packaging cooperation continues. Samsung HBM4 yield is reported above 80%, easing supply chain constraints. A mild CPI also lifted data center sentiment. Retail is the opposite of cautious. On StockTwits, among recently labeled sentiment messages, bullish share is about 92%, roughly 11-1. The SpaceX stake is being marketed like rocket fuel, and dip buying appetite is strong. Reddit evidence is thin, but Wall Street Bets shows classic YOLO chase behavior. While r/investing has had almost no discussion over the past 7 days. Long-term money is oddly quiet. The key observation: institutions are focused on financial exposure and physical limits. Retail's focused on story and SpaceX. Historically, that kind of split often means higher short-term volatility, not clean one-way acceleration. Let's zoom out to macro. The effective federal funds rate is 3.63%, with about an 85% chance of 0 cuts this year. The 10-year Treasury yield is around 4.63%. The curve is positive but narrowing. Core PCE is mild. Unemployment is down to 4.1%. Recession probability by the end of 2026 is only about 8%. VIX is around 14.63, so broad fear is calm. For Nvidia, macro is neutral. No recession supports the fundamental floor. But no rate cuts mean high multiple growth stocks do not get a valuation tailwind from easier money. And with beta at 2.215, any systemic shock can hit Nvidia harder than the market. So here is the bull case, and it has not been knocked out. Hard data already happened. Roughly $50 billion of quarterly operating cash flow, nearly $80 billion annualized buybacks. Reasonable forward, PE and PEG, bullish moving average alignment and expanding MACD. The smaller financing guarantee can be read as proactive risk control that protects the balance sheet. High inventory can be read as deliberate stocking for the Blackwell product cycle. The bear case also has hard data. The rally is happening on lighter volume. Upside to nearby resistance is only about 3 to 7%, while downside to deeper support runs about 8 to 27%. That is asymmetric and not in your favor at the current price. Inventory is growing much faster than revenue. One-time gains are a big slice of profit. Retail sentiment is crowded. Institutions are careful. And the shrinking guarantee may hint at demand-side constraints. The verdict: bears win tactically on odds, volume, and structural blemishes. Bulls hold strategically on verified cash flow and growth. At $225, chasing is not optimal, and shorting is not optimal either. Final rating: hold. Here is the playbook. Core position: leave it alone. At the current price, add no new money and do not short. For new capital, use limit orders only, in ladders. First ladder, $218 to $220, near the 10-day EMA, about 25%. Second ladder, $206 to $210, near the 50-day SMA, about 45%. Third ladder, $194 to $198, near the 200-day SMA, about 30%. Trim discipline. If price pushes into $232 to $236 and volume is still below the recent average, reduce 15 to 25% of the trading sleeve. Upgrade triggers: a volume-backed breakout through 236 to 240. Or next earnings shows sequential revenue growth of at least 15%, Blackwell guidance moving higher, and inventory days stabilizing. Downgrade triggers: sequential revenue growth falls below 10% or guidance is cut. Inventory keeps growing much faster than revenue. Gross margin clearly rolls over. Cloud providers cut AI capital spending or price breaks below the 200-day moving average on heavy volume. Risk control matters more than conviction. Size the position so that a drop to the 200-day line, roughly negative 13.5%, is tolerable. Respect the high beta and the earnings window risk. Bottom line, Nvidia is still the core beneficiary of AI infrastructure. The cash flow machine and balance sheet give it real anchor position value. The medium and long-term trend is up, but price is now inside a resistance-heavy zone. Sentiment is split, and the structural blemishes are real. The best move is to let proven growth and cash flow defend the core. Save new money for better odds, and wait for either a volume breakout or the next earnings report to decide the next leg. What do you think? Is inventory smart Blackwell preparation? Or the first crack in demand quality? Drop your take in the comments. This is for educational purposes only, not investment advice. Markets carry risk, so make independent decisions and use strict risk control.